As we have covered first two chapters of our course financial accounting, and now we are moving towards the third chapter of our course, which is the accounting cycle. So in this presentation we are going to cover the fundamental steps of accounting cycle, which will clear our understanding about the essential components of and how they work together to track financial informations. First of all, we will understand about the ledger. For that, we are going to define the ledger, that what it is. Ledger is actually the record keeping system in accounting, as it organizes the financial data into individual accounts, and each account represent a specific asset, liability, equity, revenue, or expenses. As these ledgers are used for providing a comprehensive overview of the company's financial position by summarizing the balances in each account, as it helps to track the changes in assets, liability, equity, revenue, and expenses. As we can see that different transactions are being made, and in the very first transaction there is a loan being received by a firm in which cash of 10,000 is being debited, and the loan which is being received by that firm is credited by the same that amount of 10,000. And the second transaction in which the sales of inventories are made. The cash which is being received after the sales is 10,000 is 1,000, and the sales are being credited with the same that amount of 1,000. So the different accounts are being created, like a cash account, a loan account, a sales account. And in the cash account, the 10,000 which were debited after receiving the loan from a bank is being debited, and the other 1,000 which was received by the sales is debited in one account, and the other account in a loan which we received of about 10,000 is being credited in the loan account. And then there is a separate account of sales, that the sales that company made of 1,000 is being also credited in the sales account. So in this way, the ledgers are being prepared, the different accounts are being made, and the relative transactions are being recorded in each account for the clear understanding, and by having the different balances of each account at any time of need. So we move to the next part, which is the use of accounts. As in the ledger, there are different accounts being used, like asset accounts, liability accounts, equity accounts, revenue account, and expense accounts. As we know that the asset accounts are those in which the resources are being represented which are owned by the company, such as cash, inventory, equipment, land, building, account receivables. And the liability accounts are those which show the obligations owed to others, such as loans, accounts payable, and accrued expenses. And in the equity accounts, these represent the owner's stake in the company, like capital and retained earnings. And in the revenue accounts, it reflects the incomes earned by performing different operations of the businesses, such as the sales of goods and services. And in the expense accounts, those costs which are incurred for operating the business and carrying the activities of that business for earning different revenues. And these include the rent, salaries, and advertising. So we move to the debit and credit entries, that how these are being made. In the debit entries, increases in assets, expenses, and dividends. All of such transactions are being debited. And if we see the credit, the increases in liabilities, equity, and revenue, these transactions are being credited. For instance, the loan which we got from the bank, the cash we received from the bank of 10,000 was being debited because it increased the assets of the business in the form of cash. And at the same time, the loan which was being received increased the liabilities of paying the loan to that bank. And if we see another example like purchasing a building on account on accounts or notes payable, the building which we purchased is debited because it increased the assets, and the notes payable which incurred because we purchased the building, that note payable will be credited. So now we move next, which is the journal. In journal, the different transactions are being captured. For that purpose, every financial transaction which is being performed in a business are being recorded after every event or after every transaction. Whenever a transaction is being made or an event has happened or an activity is being done, all of these transactions are being recorded in the journals. And the different details are also being provided for recording these transactions, like the dates, at which date a transaction happened or occurred, and the accounts are also being affected because of these transactions, and the amounts are also managed or changed as these transactions happen, and a brief description of a transaction is also being made. For example, if we got the loan from a bank, then the date of having the loan from the bank is also being written, and the accounts which are being affected are also being shown with the description that we got that much amount of loan from the bank. So there, these also provide the accuracy which is critical as the journal serves as the primary source of posting entries to the ledger. So now we move to the next, and it is calculating the net income. The net income is simply is calculated by subtracting the expenses from the revenues. As we earn different revenues by performing different operations or activities in the business, different expenses are also being incurred, which are being subtracted from that amount of revenue, which gives us the net income that the business has got. So now we move toward the dividends. Dividends are issued by a company when they have a certain amount of profits in their company. These dividends are being declared by the board of directors at the certain dates or at the certain times, that this much amount of dividends are going to be paid to the stockholders or the shareholders. And there are two different types of the shareholders, like preferred shareholders and the common shareholders. Preferred shareholders will be given the dividends first, and after that, the common shareholders will be given those dividends. And these payments are being made in cash usually, but if someone wants to take the other stocks in that company, then they can also get those number of stocks in that company. So we move to the trial balance. Trial balance is actually the one in which from one side there are the entries or transactions which are being debited, and the other side on which the same kind of transactions are being credited, or the alternative effects are being written on the other side. As the trial balance is the verification, as it verify or list all the account balances from the ledger, and it ensures that the debits equals the total credits, indicating the accounting equation, which is assets is equal to liabilities plus owner's equity. If this equation is balanced, then the entries or transactions being recorded are correct. But if this equation is not balanced, or the amounts of debits and credits are not matching, then there are surely some errors in recording the transactions. So we move next, which is the importance of accurate accounting. Accurate accounting is necessary for the financial reporting because these are actually seen by the investors and creditors, which see the positions of the companies by analyzing those financial reportings. And if they are not accurately being reported, then there will be a lot of chances that these entities or businesses are conducting some kind of fraud, or not giving the clear financial health or positions to their investors and creditors. And these are also necessary for decision making purposes, because after analyzing all these statements, the company or businesses can make certain decisions. And it also ensures the transparency and accountability to shareholders. And then we conclude this chapter, as this chapter is very crucial for managing and analyzing financial information. And these processes in the businesses are important because the businesses have to ensure accurate record keeping and generate reliable business financial reports and make informed financial decisions. So that's all in this chapter.